Welcome to the Power Market Report. I'm Albert Liu. U.S. stocks opened lower on Tuesday as the Dow Jones faces what could be its worst quarter ever. Joining me now is Brien Lundin, editor of Gold Newsletter and host of the New Orleans Investment Conference. Brien, thanks for joining me again on the Power Market Report. How are you?
I'm doing great, Albert, all things considering. Great to be with you again.
Yeah, glad to see you back. When I reached out to you last week, you said you were headed out of town. I wasn't sure if you were coming back.
Well, I've been back and forth to various outposts of the family and keeping them supplied with groceries and the like, but back here at home now so I can have bandwidth and do these kinds of interviews.
All right, so stocks, let's say they struggled this quarter, to put it lightly. Yeah. Looking at what could be the worst quarter ever, I'm assuming it's point-wise for the Dow. Mm-hmm. Let's try to put this in perspective. You and I weren't around for the big downturns in the 30s and the late 20s, but we've seen some pretty bad downturns. So put this one in perspective in terms of how you feel as an investor, the feedback and questions you're getting from readers. Mm-hmm. How does this fit in with other downturns we've seen?
Well, surprisingly, and I retweeted a chart recently from a friend of mine, Ron Grease, the proprietor of the Chart Store. And a plug for that, the chartstore.com. He does a weekly chart blog that's absolutely incredible. And in one of the charts he had tweeted out showed basically all the previous downturns, and we're pretty average right now. We're nowhere near the worst downturns in the stock market, but right about average. So there is the potential for further declines. People are looking at this maybe instead of being an L-shaped or a V-shaped recovery, more like a W and up and down again, and they may end up stringing some letters together by the time this is all said and done. But it's about average now. There's room for further downside, and we could have a big recovery. I do believe that this is kind of an exogenous event with an end time to it, a deadline to it that will be past it. But the extraordinary stimulus measures that the policy response to this will be with us for many years to come. And that's what people should really be considering right now.
Brien, were you not surprised, as I was, and I think many people were, pretty much everyone I've talked to except Peter Schiff, I think, at how fragile the economy was? It seems to be worse than you would expect in the sense that seems to be all of these hidden dangers beneath the surface.
Not really surprised. It's something that, I and some others have been preaching about. I've had many discussions with Peter about this, and the minor points of disagreement that we have, with Peter, they're grounds for major disagreement for if you stray from the message in only minor ways. But we've agreed that it is fragile. And the reason why is because the stock market, the financial markets, the real estate markets have become the economy. The Fed after 2008, and really to some degree after 1971 when they were broke the leash to gold and were able to spend and create money without restraint or repercussions, seemingly without repercussions. In every downturn, the Fed has loosened monetary policy to the point where it's always going looser and looser and looser with every successive downturn. After 2008, the Fed decided they had to pump up the financial markets, pump up the real estate market again, pump up the equity markets and bonds, so that they could create this wealth effect and create consumer a belief that they were more wealthy and therefore they would spend more. And instead of savings and investment, the modern economy is built upon consumption and an illusion of wealth. And that's what they created. They transformed the U.S. economy from one that was productive into one that was almost entirely dependent, or largely dependent at least, on the financial markets and the health of those financial markets, or seeming health of those markets. So when you have the kinds of bust that inevitably happens when bubbles are burst, then you have an economic downturn, and that's what we're living through right now. It's not so much the fragility, I would say, but the nature of the modern economy.
When you say it's a kind of an average downturn, I assume you're talking about the amount of the point loss in the Dow Jones. But in terms of the speed of the downturn and the aggressiveness of the response, this seems unprecedented.
Yeah, to be clear, I'm talking about the percentage decline so far. The point decline is even more impressive, of course, because of the levels we're coming down from. But yes, the speed, in the speed of everything these days is just awe-inspiring. And I, for one, predicted a lot of the policy responses. I've been saying that the next downturn, or the next time the equity markets would demand that the Fed cut rates, that the Fed would be forced to cut rates more quickly, deeper. They would have to resort to quantitative easing, and to a much greater level than they had before, and they would have to employ fiscal measures. So I expected everything that we're seeing right now, but the rapidity of those policy responses, it's been something that I don't think anyone has expected. The kinds of developments and responses that we expected to play out over 3 to 5 years are happening in 3 to 5 days. It's just absolutely amazing. And, that implies, as much as we've seen, it's not everything, and there's more to come. And they promise that these are just the first steps, and there's going to be more to come. The difference is going to be not just in the speed, I think, but ultimately in degree, because I didn't expect this much. So they have a lot of time to do much more over time, and I think they will.
Brien, gold had an epic run, an epic 10-year run beginning around 2002. And if you look at our current situation, the economic backdrop for gold couldn't be better, in my opinion.
Right.
Do you think we could be in for something like that again?
Yeah, absolutely. I think we're going to see that script play out again. And I think it's a multi-year bull market. If you look at a few things, before this all happened, one of my big areas of focus for some time has been the enormous creation of debt. It's been a growing problem, as we know, for decades. But after 2008, it just exploded higher because interest rates at 5,000-year lows, among many repercussions and unintended consequences of a policy like that, is debt creation. It encourages debt creation, sovereign debt creation, corporate debt creation, personal debt creation, all across the board. And just from a sovereign level, the federal debt has absolutely exploded. I was preaching to my readers and followers that we were facing a situation where we could no longer afford to service the debt, the federal debt, if interest rates were positive on a real inflation adjusted level. So we would have to have negative real rates going forward. It wasn't a matter of they will trend here or they will likely trend here. They had to trend there. They had to be negative on a real basis because the dollar had to depreciate more quickly, faster than the interest rate on the federal debt, or the budget would be crushed. Now, all of this was before this COVID crisis and the policy response that we've seen, which has been absolutely amazing. So the debt is growing, which was already out of control. The debt was already out of control. So now that rate of growth has just soared. Instead of a $1 trillion deficits, which we were just facing the return of that awesome level of deficit creation every year, we're going to end up with $2 to $3 trillion deficits now, and that implies even greater growth in the debt, because there's a lot of spending that never even hits the budget. So the debt situation, I think, has created an environment that's enormously bullish for precious metals, really for as long as this current monetary regime is in effect.
Brien, we're going to have to leave it there, but thank you very much for coming on. Let's do it again soon.
Great to be with you, Albert. Anytime.